Hey everybody, it's good to be here. Happy Tuesday to you. Time for long options. Today, we're going to go back to the basics, the foundational elements of long options, why people consider using them. And, if you're new, I think this is a great place to start. If you're more experienced, that's great. It's good to go back to fundamentals. Okay, we do that we do that in sports a lot of times, or other aspects of life, going back to the fundamentals. And plus, we'll look at a couple example trades there that you can maybe look at doing in your paper money account if you wanted to. I'm joined alongside by my friend, my longtime colleague, Ben Watson. If you haven't had an opportunity to go to one of our live workshops around the country, Ben is the principal instructor in those for good reason. And so make sure you check those out. Make sure you also follow Ben on X at Ben Watson CS. You can follow me on X at Brent Moores CS. And remember, options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not a recommendation of any security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money software application is for educational purposes only. I may not factor in commissions in these trades, but just realize they are a real thing. You gotta consider all investing involves risk, including loss of principal. And let's see, no guarantee in execution of a stop loss at or near the activation price. Past performance of any security or strategy does not guarantee future results or success. And these are all just examples I'm going to go through today. No recommendations here. Good to see some familiar names in the chat. Grateful you guys are joining us. And if you're watching on a recording, that's great too. We're just happy to have you. Here's the market right now. We're down about 0.5% or so on the S&P 500. You can see we climbed out of the depths. Maybe a little bit of a pullback right now, a little bit of a flaggy pattern right now. It's potentially possible. I could foresee maybe, by the way, just kind of looking at the markets here before we get into the heart of the matter here, I guess. It is certainly possible that we maybe overshot the mark. We've come back, but now we're seeing a little weakness. We've seen some trading here, potential resistance, potential support. A little bit more of a sideways move is a possibility. I don't know. Now, that's for the market as a whole. We can look at individual stocks, of course, and they may look very different. And so what I want to do is I want to talk about long options and why some traders consider long options. I want to talk about pros and cons. I want to give you a very balanced approach here on this, because there are pros and cons to any strategy. Long options are no different than that. But I want to talk to you first, kind of the conceptual reason why a lot of people do long options, and then go through kind of a listing almost of pros and cons of those, and then actually look at real life examples of just example trades that for this. So NK made first trade on a live platform. We wish you the best there, NK. Everybody has their first, so that's where you start. You gotta start somewhere, I guess, huh? Okay, so here's what my theory is on Qualcomm. And remember, like any stock you're looking at, you got to do its individual forecast here. What I'm going to say here is this: we've kind of had this uptick. It struggled like the rest of the market here, but since then we've had higher lows, higher highs. Looks like we're bouncing, and I'm going to assume here in this case, the stock goes up to about 150. Okay, that we're going to bounce from here, that we have a support level, that we bounce up there to about $150. Now, of course, I don't know where the market's going. I don't know where Qualcomm is going. That's just our example stock. But in this case, I want to just discuss why someone may consider an option here in this case. With long calls, it's a bullish trade. But you got to ask yourself, because there's a lot of different choices you have. Of course, you always have a choice to not trade, but you have the choice of maybe your inkling is to buy Qualcomm, 100 shares of Qualcomm or something like that. So let's kind of just go through the math here on this. And I'm going to just I'm going to just round here a little bit. I'm going to just say my target is $150. That's right about where my resistance line is. That's right about where our past support levels were that we broke through. Our most recent bounce was around 150. Our stock's about 139 right now. So if we were to go up $11, 139 to 150, if I take $11, divide that by 139, I'm going to come up with about an 8% return on the stock. That would be a stock return 8% if we hit if we hit that 150 mark on that. Okay. Now, what if we did a long call instead in this case? Okay, and again, there's going to be pros and cons on this trade. I'm just going to kind of give you the conceptual framework of what a reason why people may do this. But there's some cons too, because the initial thing I'm going to show you may look pretty good. Let's do this. I'm going to go to the Theo price. And if you're not familiar with this Theo price tool, it models options prices. Okay. And so let me go here and I'm going to click on Theo price and then it'll bring it up here. And if you've used it in the past, it may have some old numbers in here. So always just reset it when you start out. And what I'm going to say is that stock is going to go up to about $150. So I'm going to say up, what is that? $10.70. Okay, the numbers may change just a little bit, but this will give us the point. I'm going to say it takes a couple weeks to get there. So today's the 6th. We're going to say it goes to the 13th. Okay, so there we go. Let's look at a long call. I'm just going to go at the money. Stock's at about 139, so about 140, and the current mark price is about 537. What is the option price now? It's at $11. That's the Theo price on that. That's the Theo price. It's not a guaranteed price, okay? It's not a guaranteed price, but theoretically, in this case, instead of the 8% return, it's, I don't know, it's over 100% return on that option. Not bad, right? Do you see the attraction of options? And I don't think, I don't think that's an unrealistic move here on this. It's an optimistic move, but I don't think it would be shocking if this stock went up to this level there on that. So it's always important to keep in mind reality as we're teaching there. Okay. So there we go. So let's do this. Let's talk about the downside on this. What if instead of the stock goes up $10.70, what if it goes down $10.70 in that same time frame? Okay. How much are we losing on this? Well, we'd be losing if the stock goes down, that'd be roughly 8% or so. Maybe the math may work out slightly different than that, but somewhere in that ballpark. How much would the call then be worth? And I'll hit questions here in just a sec. Okay. How much would the call be worth at that point? Well, let's see. Remember, we're buying for 540. Now the Theo price is around 69 cents on that. So we've lost over 80%, the better part of 90% on that trade. Okay, so it's a leveraged investment, in other words. And if you think it's going to go your way and you're willing to take the extra risk of the leverage, that's why people do long calls and long puts. Long calls if you're bullish, long puts if you're bearish. We could do the same example and just look at puts, which are going to be the right side of the page, do the same numbers, and you'd get probably something pretty similar in terms of returns, except they'd just be opposite, going up and going down there in that case. All right? So that's the first thing I wanted to cover with you, is just kind of the reasons why people do it. Let me hit some questions, then let's hit pros and cons here on this. Okay. Let's see. Question on... I saw it here just a minute ago, why I use a 1 month debt. Okay, look, when you're choosing a time frame on a chart, Okay, this is a good question. This is from Garrison. No, Chuck, here I go. Thank you, Chuck, for the question, because it's a good question. Why do I use 6 months? I have no specific attachment to a 6-month daily chart. But what I would say is this: when you're looking at a chart, you want to be broad ranged enough that you don't lose sight of the trend. And sometimes if I go too narrow, if I go to a 1-month chart or even a 3-month chart, sometimes I lose sight of the overall trend and support and resistance levels. Okay? If I go to a 3-month chart, I'm not going to see any bounce back here, for example, there on that. So that's one reason why. Now, what about going to a year or 2 years or something like that? You can do that, but then you lose some of the detail. It's a little harder to see some of those candles. And for our purposes here in terms of demonstration, I want you to be able to see the candles there. So I'm hoping that's answering that question there. Good question there. Let's go on. Let's see. Now, other questions. Can we use other things? Can we look at like an RSI? You can look at an RSI, certainly. You can look at a MACD. You can look at stochastics. You can look at other indicators if you want. In fact, I have done a couple sessions, okay, in this class, in this webcast. January 7th of this year, I did a trend trading sample plan. January 14th of this year, I did a swing trading sample plan. If you're watching on a recording, you can go to the playlist for that and look at that. And so I just put in the link, if you're watching live, a link to that trend trading sample plan class. I'm not going to go into all the details here on that, but certainly you can use support levels, resistance levels. You can use indicators, oscillators, whatever you think is best for you in terms of forecasting the stock. Today we're going bare bones. Okay, so I'm not going to do it today, but just realize, yeah, absolutely, you can do that. Now, here's the thing. This is what I'm going to do. I'm going to go and I'm going to talk about pros and cons, and I'm just going to list them out here. We'll look at some examples here in just a minute, but these are just some pros and cons. Leverage, okay? I put that as kind of number one here, and this is pros and cons of long options. We're starting with pros, there'll be plenty of cons too. Leverage, in fact, hint, leverage is going to be on the cons list as well. We saw just an example of if the stock went the direction that we want, just how much it can accelerate potential returns in that way. Okay, so that's kind of a nice thing. So there's either an unlimited theoretical gain in the case of a long call, or a very large theoretical gain in the case of a long put. Okay, so either way, very big potential gains, but of course you would need a very big potential move to get those. Okay, so that's kind of number two on my list there. And this may not be an exhaustive list. Maybe there's something I'm not thinking about here. But it's directional. It can fit your directional needs. Okay. In other words, if you're bullish, you can do long calls. If you're bearish, you can do long puts. So you can have it go either way. Now, neutral trades, yes, there's options, neutral options trades. That's not what we're doing today, though. Today we're not doing long. We're doing long calls, long puts, which are directional. But one good thing is, like, you can use them as a hedge. Okay, they can be used for hedging. If you buy a long put, often we'll call it a protective put. And let's say you own the stock and the stock goes down, you'd be, well, darn it, that stock went down, that stock's going down. The long put may make up for a lot of that potentially there. So that's another good reason there. Let's see what we got here. Let's go to, well, and this is a kind of a weird one. limited risk. And when I say that, compared to, you can lose everything. So you're going, what's limited about that? As opposed to short options, though, that risk is maybe, where you may have a theoretical unlimited risk, even, for example, in the case of a short call, okay, or unlimited, or a very large theoretical list in case of in the case of a short put there. So those are some of the pros there. All right. Let's go to some of the cons. Well, I'm going to start off my cons list with the same thing I started with the pros list. Leverage can work for you or it can work against you. We talked about that. We showed you how that can go against you. So you're only going to do this if it's more of a little bit more of an aggressive stance in terms of your trading. I'm going to write down time decay. Okay. I'll put here theta. Okay. When you're doing long calls or long puts, time is working against you, everything else being equal. If the stock, you may overcome that with enough stock movement, but if the stock isn't moving, or that time decay is eating away at it to a certain extent. Let's say you buy a long call and the stock even goes up, you're going to make a little less than you otherwise would because of that time decay. And this is something I could have put on the pros as well. Volatility, we'll put Vega. That it can help you or it can work against you. Okay. If implied volatilities go down, it's going to tend to work against your con. So all told, what that means is there's more uncertainty. Pricing can be confusing, I guess is a way to say it, because it's not just the stock price. You may say, well, long calls, bullish, long puts, you're bearish on the underlying stock. But then you have time decay, you have implied volatility changes. That can certainly affect things. And there's one other thing I would just mention here in terms of my list of cons, and that is it expires. And so since it expires, what that means is not only do you have to kind of guess the direction, but you also have to have the time frame right on that. Okay? Because maybe you're bullish on it, but it takes too long for it to turn bullish. Your option may have expired by then. And so those are kind of some of the basics of why people use long calls or long puts. But I wanted to give an example here. So I want to do something. I'm going to pull up, let's do a kind of a bearish, I'm going to do what's maybe a little bit more of a bearish example. I'm going to take Merck here, Merck. And the reason is that the trend has been kind of going down, right? That's the reason. We have some downward momentum. In fact, today is not a good day for Merck. Most of farm is down today, almost 4% today. So we have downward momentum. We have potential resistance. We've gone down. And I'm going to call this price down here a target price. I'm going to say 76 is my target price, where I'm thinking maybe Merck is going to go there. Okay. So if you're not bearish on it, then you want to do a long put. But this isn't, we'll do calls and puts. We'll do both bullish and bearish here, but I wanted to do this as a possibility. And so we said 76 is the target on this. Whether you're doing long calls or long puts, liquidity does matter here. Okay. Liquidity does matter. So if I go to trade, and I'm going to look at the puts now. And for our purposes today, I'm just going to go basically at the money. The at the money contract, the contract that's closest to the current stock price is the $80 contract. And I'm going to go out a little bit farther here. Let's go out 45 days to the monthly contracts. We'll go to 80 here. And there we go. Check out the bid-ask spread. Some stocks, it makes a big difference. if I go here, well, let's see, where was that? Let me see if I can find another one that illustrates this a little bit. Actually, those aren't too bad. I thought what I was looking at, now they've tightened up a little bit. Sometimes you'll see kind of a big difference between the bid price and the ask price on these. And so if you go to the monthly contracts, those are the ones that don't say weeklies next to them. Okay. You may have better luck in terms of bid ask spread, liquidity there in this case here. You can also look at open interest to try and help in that regard. Okay. So, let's see, Isaiah says, would you say a daily chart for trend direction and short-term charts like the 1 hour, 20-day for entry? That's a good question, Isaiah. I wouldn't say that there's anything wrong with doing it that way. You don't have to do it that way. Typically for these daily chart, daily chart, when you say daily chart, with each candle represents one day or each bar represents one day, then a lot of traders, and typically in the classes I teach, we are using the daily chart both for entry and for things like trend. But certainly you may decide, I want to go intraday on that to try and help us out there. So you could change your time frame. Isaiah said, I think 1 hour, 20-day. Absolutely, you can certainly do it that way. So use whatever you want. If you're trading options, you can have very different sets of entry rules and exit rules on these. So you just got to decide on that. But here's what we're going to do. I'm going to go to the $80 put, and I'm just going to click on this for a sec. So this is a put. Now, if I were to look at this and say, well, what if the stock goes down to where I wanted, expected? And we said $76. Well, let's use that same Theo price thing we were using before. I'm going to reset this. I want this to go down to $76. So that's about $3.50. What kind of potential gain if it goes down $3.50 are we looking at? That's right around 76 bucks. And I'm going to say it takes about a week to get there. So I'm going to go out and we'll go right here and let's see what we got here. Theo price, $5.97, Mark, $4.30. In other words, in terms of percentage gain, well, let's see, that's about a 170 gain divided by my starting price of $4.30. That's about 39% return there. Now, some options can be a lot more than that, but 39% isn't anything to sneeze at. And remember, this is a way of getting in a potentially bearish trade. So when we get in, we're going to decide when are we going to get out, and when are we going to get out if it goes against us? When are we going to get out if it goes for us? And what if the stock goes sideways and just kind of doesn't do anything? Because remember, time decay is working against you. All right. Let me just zoom in just a little bit here on this. And here's what I'm going to say. We had this nice breakdown. We went up, nice big candle here, and then we hit yesterday, and and then today we've had a nice big candle. I'm going to go halfway up that candle. If we reverse halfway up that candle, right around $81, then I'm going to look to get out of this trade. So I'm trying to ride the momentum here. If I want, to someone else's point earlier, we could look at that RSI to try and help us out with the momentum. You can do other things like a MACD or a momentum indicator to try and help you with momentum. You can look at the price action to help you with momentum. But the point is, have your target price, which we said was 76. Have your exit price. If it breaks above 81, I'm going to look to get out of this guy. And then what you can do is you can do the trade. You can simply right-click on the put option. I'm going to buy custom, and I'm just going to say buy custom with stop. Here's my initial trade. And to get out, I'm going to go stop. I'm going to go market. I'm going to go good till canceled. I'm going to click on the little gear here on the far right. Now, you may not see a little gear. Do you see a gear? No, the gear is not showing until you put your cursor over to this side here. Okay. So here we go. Let me just shrink this down just a little bit so maybe you can see it a little bit better. Okay. Now, we're going to submit this. This is the closing order. The green order is our entry order on this. The exit order is our closing order. Well, when are we going to get out? We're going to get out if we put in order conditions, if Merck marks less than or equal to 76. We're going to get out. I'm going to click on the line right below that. Merck marks greater than or equal to 81. Or you could give it a little buffer, 81.5 or something like that. There's 81.5 there. Okay, so I'm going to click on save. Now, if I want to model those prices, I can do that. I can go back up here and say, well, we already did the 76. What if the stock goes up to 81.5? Well, what would that be? That's like the stock's at 79.5. That's basically a $2 gain here on this. How much would we be losing if the stock goes up? Well, the Thiel price goes from 430 down to 307. Okay? So that you can model and get it. It's not a guarantee. It's not a perfect model. We don't know exactly what the price is going to be, but that gives us some sort of idea. Now, Frank said, you could do a vertical. You could do a vertical. Absolutely. If you wanted to do, say, a short call vertical, that's a bearish trade. That's a trade for a different webcast. This is a long options webcast. Absolutely. You could do a long put vertical. Okay, that's a bearish trade. Again, that is for a different class. But these are all possibilities there for you. So I have my entry and I have my exits. Okay, so let me click on confirm and send, and I'm going to send this trade, and we're going to actually put this in my long single options bucket there. Okay, let's look at another example. I thought maybe we'd do a bullish example as well. Okay, so for this one, I was going to go to something that had some rough times here. Let me zoom in just a little bit. We had Alphabet, and the general trend was down. At this point, we have a low, we have a higher low, we have another higher low, high, higher high, another higher high. That is a trend reversal. We're now above both our 20 and our 50-day moving average on Google, on Alphabet. Okay. Now, if you are bearish on this, then you wouldn't do a long call. But for our purposes today, I want to kind of illustrate a long call here on this. All right. Now, how far is this potentially going to go up? Well, I don't know. I'll tell you one way to do it, though, is when you're trying to come up with targets, if you measure moves, you can say, look, my past move went from there to about there. That's about a $21 move. I'm going to take that. I'm going to right-click on that, and I'm going to duplicate that. I'm going to take that. I'm going to say, what if our next move is similar? We've gone up, we've kind of pulled back. I'm going to go from low to high, and I'm going to put that right about 180, okay? 180 is the move that I'm looking for here. I'm going to look for this move to repeat. Now, we could have done this. That one may be a little bit bigger. That's all right. There was a little one there. That one's a little smaller. But I'm going to go just shy of where that target is. I'm going to go to about 180. All right. Now, I'm also going to put in a stop. Well, I'm going to put in you can put in a stop based on the option price or the stock price. In the last example, with the long put, we put it all based on the stock price. We can do it also based on the option price. So I want to give you that as an example as well. But how much would this potentially be worth if it goes up to 180? Well, we're going to say about 164 right now. Okay. 164 up to 180 is a $16 gain. Well, let's do it. Here's Google, Alphabet. We're going to go here. Let me reset this. I'm going to say about a $16 gain. That's about a 10% gain on the stock. Okay. So about 163 right now. And I'm going to say it's going to take a little bit longer to get there. Let's say it takes 2 weeks to get there. And that's obviously just an estimate. I don't know how long it's going to take there. But then we can look at our options and we can say, well, is that, how much is that? We'll go out 45 days here. Okay. And I'm going to go at the money again. Stock's about, well, we'll say about 165 is just out of the money. Excuse me, just in the money. We're not looking at puts, we're looking at calls. That's going to be just out of the money in this case. Our bid-ask spread is about 5 cents on that. Okay. Now, that's great. How tight should that be? I don't know. What I would say is this. If it's more than 10% difference between the two, that's probably too big. Less than 10%, that's looking better. Ideally, something I would say maybe 5% within each other. Well, what's 10% of a $6 option? That'd be about 60 cents. 5% would be about 30 cents. Here, we're about 5 to 10 cents difference. It's just changed on us. Difference between those. That's probably looking okay. Another thing you can do is this. You can look at open interest. Okay. You can go up here. Let me go to open interest. And you can look and see what the open interest on these. This has many thousands. That's quite a bit. But if I go to a different contract, let's go to out 31 days. Let's look at the bid-ask spread on this again. Okay. Again, nice tight bid-ask spread. Open interest, several hundred. And several hundred is fine. But sometimes you're going to see some on different stocks. Alphabet is very popularly traded stock with very popular options. So we call those liquid. Well, a lot of trading on those options, which means you're more likely to get better prices on those. If there's a bigger market, you're more likely to get better prices. And sometimes you'll look at it and you'll look at that open interest and it's not going to be 421, it's going to be 5 or 1 or sometimes 0. Okay, that is probably not good. And the thing is, they're probably going to be related because what you're going to do is you're going to see that bid-ask spread, the difference between those, and it's not going to be within a few percent of each other. It may be 30% from one another. When you get those low open interest situations, that's what happens. Okay, so there we go. So that's the liquidity we're talking about. Now, what expiration month do we do? Well, I already talked about there's different kinds of trades. I mentioned I have a trend trading sample plan. I put the link for that in the chat. The swing trading sample plan. But ultimately on these trades, you need to decide how long you're planning on being in this trade. If I'm planning on being in this trade and I just want to stay in, as long as this trends up, and I think it may just trend up for a long time, let's say that as an example, then you're probably you need to buy more time. Maybe instead of going out 31 days, maybe you go out 70 days instead, or 100 days instead. But if you're planning on being it for just a few days, well, I wouldn't say you're going to necessarily buy something that's 3 days. You want to give it a little bit more time to work its thing. In other words, a lot of times what people will do is they'll say, well, I'm going to take however long I think it's going to take, and then add on a couple weeks or more on that. So in this case, I said it's going to take at least a couple weeks. Well, we'll go at least 31 days on this. Okay, I'm going to go to, again, I'm going to go kind of at the money contract here. I'm going to right click on this. I'm going to buy custom with an OCO bracket. What's an OCO bracket? An OCO bracket is this. It's the buy, this is the buy custom part. We're buying this option, Alphabet option. We then have a bracket order, one that's going to sell us out at a limit, and one that's if things go well, and one that's going to sell us out at a stop. That's if things don't go so well, if it goes against us. And so where are we going to put those in? Here's what I'm going to do. Let's start with the stop. I'm going to go to the stop. I'm going to make it good till canceled because I don't want it to expire today in 3 hours from now or something. So I'm going to make that good till canceled. And I'm basically, what I'm going to say is, let me make this a little bit bigger, is I'm going to put that stop in at about 50%. Okay. So we're buying it around 520. Okay. Let me just look here. Buying about 520. So I'm going to go put it in at, what's 50% of 520? 260. 2.60. 50% stop. Now, does that stop guarantee that we're going to sell out right at 260? It doesn't. Okay. It turns into a market order at that point, actually. But that is a stop order to try and help us on the downside. That is placing it based on the option price. Remember, when we did our example on Merck, we did it based on the stock price. This is based on the option price. Okay. What about this? Well, in this case, I can say, well, I want to get out at, what did we say, 180? If I want to get out exactly at 180, I can do that. Maybe it may not get us out exactly at 180, but what I'm saying is I can base the exit based on the stock price like we did before. And just to refresh myself on this, let me just go back to Theo price. And what was, so that would be, a Theo price is about $15. That's more than doubling this trade here. I could do that though, right? I could put this order and say, I'm going to just make this a market, good till canceled, click on the gear, and say if Alphabet marks greater than or equal to 180, I'm going to get out. Okay, that's one way to do it. We already demonstrated that, so I'm not going to do that. Let's mention it this way though. What if we just double the price? Would that be, yeah, that'd be a nice thing. So I'm going to double this price. I'm going to say, I'm going to get out at a limit, a sell limit at twice this would be 1040, 10.40. And that's going to be good till cancel as well. So this order, instead of basing it on the option price, we're on the stock price, we're basing it all on the stock price. So let's say this fills and we get in this trade. Okay. Let's say this fills and we get in this trade. Then what we have is we have two sell orders. One to get out if we hit at 10, if it gets to 1040, one to get out if it goes down to 260. Now, this is not what we call a high probability trade. Okay. We're closer to our stop than we are our target, than our limit price, number one. Number two, time decay is going to be wearing on this. It's going to be working against us. But, so it's not a high probability trade, but what it does have is, at least theoretically, we have a very positive reward to risk ratio. A very positive reward to risk ratio. Because look, how much we stand to gain if we got out right where our limit order is. We stand to gain 520. How much do we stand to lose? We stand to lose 260. Okay, 260. So basically that is a 2-to-1 reward to risk ratio. So lower probability trade, but higher return reward to risk ratio. And that's a kind of a typical approach to trading long options, whether they're long calls or long puts, doesn't matter. Trying to keep the reward to risk ratio positive, greater than 1-to-1, ideally maybe 2-to-1 is just a common approach to that. All right, so here we go. Now the price has moved a little bit since I started, but I'm just going to do that, and I'm going to confirm and send, and I'm going to put this in my long single options. So that's a bullish trade. Okay, let's answer questions, and let's let me just kind of review kind of the key points we had there. So looks like Nora asked about liquidity, which we addressed a little bit, and Ben gave some more color on that. And Nora asked another good question on candles. We'll do that. Let's see. I think, Ben, thank you very much. I think Ben kept us up to date on answering questions. I appreciate that. Okay, so here's what I wanted to do today. I wanted to, number one, introduce you to why people do long options. Remember, we gave you that example of just how big of returns potentially you get with the leverage versus just from a percentage basis versus the stock. But we also emphasized that leverage can work against you too. So we talked about pros and cons of long calls and long puts, including time decay working against you. Okay. We gave examples of long calls for bullish trades, long puts for bearish trades, and we also gave examples of putting in exits based on stock prices and based on option prices. So that's kind of an intro, I think, to long calls, long puts. Each week in this class, we try and hit up different aspects of this. If you want to go back through the playlist and check out more, some maybe more advanced subjects as well, make sure you check that out as well. Also, make sure you check out some of Ben's webcasts, in addition to his schedule of doing live workshops around the country. He teaches a great Market Movers webcast on Fridays. It's a great way to kind of summarize the week, look at the week ahead. And so that's Fridays at 4 o'clock Eastern Time. Ben, thank you for helping me out today. Thank each of you for joining me today. And everybody have a wonderful rest of the day. Coming up next, we have getting started with technical analysis. So important stuff. Make sure you check that out. Have a great rest of the day, and we'll see you same time next week. Bye-bye, everybody.